Today, we will talk about earnouts. An earnout is a provision stating that the seller of a business will receive additional compensation in the future if the business achieves certain financial goals, usually stated as a percentage of gross sales or earnings. For example, a purchase price of $1 million plus 5% of gross sales over the next 3 years. Earnouts don't have strict rules. Instead, the payout level depends on factors like the size of the business, and it helps bridge the gap between buyer and seller expectations. It also eliminates uncertainty for the buyer, as future financial performance determines the remainder of the cost. Different targets like net income or revenue may help determine earnouts. Aside from cash compensation, an earnout structure should consider important members of the organization, the executive's role post-acquisition, and the length of the contract. The agreement should also specify accounting assumptions going forward, and financial metrics used to determine the earnout. For the buyer, advantages include having a longer period to pay for the business and not having to pay as much if earnings are lower. For the seller, the advantage is spreading out taxes over a few years. However, a disadvantage for the buyer is the seller's prolonged involvement, and for the seller, low future earnings means they do not make as much from the sale of the business. For example, a business with $50 million in sales and $5 million in earnings may use an earnout to bridge the gap between the seller's asking price and the buyer's offer. An upfront cash payment is combined with an earnout if future sales and earnings hit certain targets within a specified period. Here are 3 key takeaways. 1. An earnout provides the seller of a business with additional compensation if certain financial goals are met. 2. An earnout helps bridge the gap between buyer and seller expectations and eliminates uncertainty for the buyer. 3. Key considerations when structuring an earnout include earnout recipients, accounting assumptions, and the agreed-upon time period. Hope this would help. Thanks for watching.